All right, we should be recording now. Anyways, so to start, guys, we had this thing going for exactly what we were gonna do as far as what we're gonna go over. But really, the more I started thinking about it, I just wanted to cover questions that we generally get. And the last training session, 30 minutes of it was me talking, and then there was an hour of questions. So generally, it tends to be the questions that take us in different directions. And that's what obviously if a question's on somebody's mind, that's the most valuable piece of information to them. So that's what I want to cover. But um, have the charts up if we want to look at specific examples, or when we do look at specific examples, and we'll look at some points we want to cover here. So people ask a lot of times. We'll get kick right off, and if you have questions, feel free to ask along the way. But just to begin, I kind of want to start with some basic stuff about what we sent out last week, and the information there. That's important information to go over because this forex trading is important. Yeah, you can, it's great in and of itself, but in order to protect where we're at, we need to understand where things are going. And one of the best things I tell people is, and one of the things I think strikes the biggest chord is that whenever equities don't generally reflect the health of the economy, one of them's going to correct. And I think that's a very important point that I want to get across to people, because everybody in the room and people that hear me on a weekly basis in the training room, they hear me talk about a lot of different subjects that maybe aren't specific to forex, but they're specific to their their finances. And that's one of those topics where generally we don't put that on the front of the site, but I feel it's important enough to do so. So, anyways, check that last video out if you or last series of videos if you haven't. It was a good special that ran. It's about an hour worth of video. Moving on here, we have. I want to cover some questions. The first question we get is why what moving averages are on the chart, number one, and why do you have pivots on your chart, and is there anything else you look at? We talk a lot about how smart money manipulates the market. Now, this manipulation is what gives us the indication of the next direction. If you think about it, the manipulation we're seeing in equities right now gives us the indication of the next direction. Equities are not reflecting the general health of the economy and the general overall worry. Because of that, that tells us that more than likely that manipulation, that is clear manipulation. They're holding the price up artificially. They're doing it right now they're doing it with quantitative easing. As they hold the price up, that is showing us clear manipulation. That gives us an indication of the next push down. So it's the same thing with anything we do on a short-term basis. The manipulation is always the key to what the next short-term direction is. And that's why we talk about certain things like the 200 EMA, 60 EMA that you see on the charts, pivot points. Some people use fibs, but are they using them at face value? Generally, how fibs are taught. Well, as we talk about over and over again, smart money uses orders in pushing traders around. Now, we're not just talking about retail traders, because retail traders make up a very small, they make up a 10-15% of the overall market. So when we talk about retail traders, and we get a lot of, as I've mentioned in the room many times, we get a lot of emails from what I would term as professional traders, traders that are working in the industry, and they say, hey, I agree with this, and one thing you might want to look at is this. And so there's a lot of back and forth there. And one of the things they always say is a lot of the people running the market, those on the floor, those that are trading for different funds, those that are trading for um, different institutions. A lot of them have really no idea the way the market works. They have an education in business, but a lot of them don't have an education as to how the market works. And that's something that they're thrown in the position. They're just driving volume. They don't really understand how the market works. And a lot of the same mainstream strategies, such as fibs, pivot points, moving averages, these are things that it's not just retail traders that are using these. And so, in other words, there's massive orders stacked around those points. And so, that's what that confluence of points gives us the indication. The only reason we look at pivots, moving averages, or if some people, some you'll see some people on the forum have fibs drawn on their charts. And the reason we're looking for that is when you have all those points coming together generally at once, those tend to be good manipulation areas. And so, especially the 200 EMA, you look at how the market responds to the 200. The 200 EMA is a moving average that has been used for years. If you're watching TV, a lot of times you'll see it on their daily charts because the 200 moving average, a lot of times they're using it as a simple moving average. I have it as an exponential moving average. But a lot of times you see it as a moving average is the fact that or you're seeing it as a moving average, and it's because a lot of people are using it. It's a very common moving average. What that tells us is there's going to be a lot of orders in and around that price. That's why we see the market manipulate around that price. So when we have, for example, when we have the 200 EMA lining up with a daily pivot, lining up with an already proven higher low, lining up with a fib point, that tells us there's going to be a lot of retail orders around that price. And when we say retail orders, we're not just referring to the average everyday person here. We're referring to everything else we just talked about as far as what I would term as a retail order. I mean the target of, I don't want to say it's not that they're targeting any one person. It's that they're targeting generally where the orders are going to be stacked. And so a lot of even floor traders are using pivot points. They're using the momentum through pivot points. One of the better traders on the floor, and he has actually a series on YouTube, use nothing but pivot points. And the point there was the thing that makes it different for them to be able to use what I term as a retail strategy versus us is that they're able to see and feel momentum, and that's something that behind the computer screen you just don't have access to. And so it's even on the professional side, there's a lot of orders being used there, but they're not on the banking side. Again, I'm not referring to just retail traders. Um, yeah, that's true. And so when you talk about where the orders are stacked, it's not just retail traders. You're talking about everybody that's outside of the major liquidity in this market. 10 banks drive well over 50% of the volume. I think it's actually closer to 70%. You'd have to look back. It might be a bit lower than that, but you have a very small percentage driving over 50% of the volume. And so it is an internal battle bank to bank. It's not like all the banks are driving the exact same volume on a daily basis, but there's general points where every one of the banks are going to be looking for orders. And that's because all retail traders trade the same. And in general, even on the what people would term as professional trader side, uh, generally trading the same way as well. Support and resistance is something that is manipulated as far as funds are concerned, as far as trading institutions are concerned, and a lot of professional traders. One of the last emails we had was a guy that he emailed us. It's kind of a funny email. He really and I'll get into levels a bit more in a second, but he said, I love everything you're doing. I'm glad to see somebody is teaching this, and it's great to see that. The one I'll get into the one issue he took with us because we're uh, I'll get into that here in a second. But the one thing that we constantly get from traders is that they take, when we say smart money manipulates retail orders, they take this as just the retail trader, and that's not the way it is. Most professional traders will tell you that they're using the same standard strategies. Maybe they're not getting sucked into the different indicators and things like that, but the same general strategies of trading support and resistance, trading fundamentals, things like that in the short term can see heavy manipulation, and we'll cover that manipulation on the fundamental side here as well. Well, you got to understand that it's not a choice for them to know we're here or not know we're here. the fact is they have to have the liquidity. And so, yes, they get liquidity internally. They get liquidity from what I call general order flow. They also get liquidity from people like you and I. You look at FXCM, go look at who the big shareholders are in FXCM. They're owned by the banks. So don't think they don't know where the orders aren't stacked. In general, they also know where the orders are stacked as far as the orders being processed through them. And so even though it's not a centralized market, if you generally know where, you know, 20% of what they would term as outside volume is stacking their orders, then they're going to know that's a consensus. And so that consensus tells you, okay, the orders are stacked at this psychological barrier, or they're stacked at, one spot 3,000 on the euro, just below it. And so by getting that consensus of 10 or 15% of the market, however much they drive, by getting that consensus, they generally know where the rest of the market's at. Well, that's one thing we're going to get into a bit more, John. We get a lot of questions on levels. Probably the biggest questions we get are on levels, and I think there's some clarification that needs to happen with the discussion on it. Really, it's the mindset of discussing levels, and we can get into that a bit more. And this actually brings me to the point I wanted to. And guys, I'm gonna try and not ramble on forever. I do have to head out. I have a date with the jet skis here later on today, but uh, I want to focus on these key points, and this is an important point. So, um, yeah, I can do that. All right, the key point here, we get a lot of discussion with levels, and we put a lot of information on the site about levels. The most important thing, uh, the most important thing to look at as far as your levels, and this is one thing that going into it from generally the biggest conflict we have among what I would term as a professional trader is they take issue with levels. And the reason with that is because there's no XYZ way to trade the market. We get emails from people that say, I've been I've bought every strategy out there. What can you guarantee me, or can you guarantee the fact that this will work? And the email response I give to them is no, I can't guarantee that because I can't fix what's in somebody's head. I can't fix the fear you have. I can't fix the greed you have. I can't make you a disciplined trader. I can't I can't fix those things that are between your head. Those are things that I can show you how to fix on in the room. We give tips on how to fix those little psychological factors in the room and exercises you can do. But that's something we can't control. Chad and I can't control that. And so it goes back to levels. I've always said that somebody with a a type A personality, or what I would term it, is going to have a difficult way or a difficult time trading levels. If you have to understand every single push in the market, it's going to be very difficult because the levels are a guiding force. They give us a good indication of direction when they're clear. And one thing I wrote in the forum lately, or one thing I wrote in the forum recently, is because we have seen some very unclear cycles. They've been clear, and then they've essentially really didn't give us a strong indication of direction again. And what I wrote was, what triggers the trade when the levels are clear, and what triggers a trade when the levels aren't clear. And the bottom line is the short-term manipulation is always the last indication we look for before taking a trade, whether the cycles are clear or whether they're not clear. And so as a trader, we need to understand that, it's not like smart money comes in and goes, okay, well, we've made our second push, so you know what, we're going to we have no other choice but to accumulate during Asia, then manipulate before making the third push. The fact is, there's a lot of variables that go into it. And so while generally the market tends to be ran in 3 cycles, this is something that's been around long before me and will be around long after me, and has been around longer than anybody has been alive in this room, more than likely. And the reason is because the market tends to be driven in 3 cycles. It's cycles on an intraday basis and cycles that tend to happen on a a weekly basis, meaning over the course of a week. But you look at also the fact that you go to your weekly chart here on the euro real quickly and look at the cycles that we've been in since the beginning of January 2009. You will see 3 separate cycles separated by accumulation in the euro on these pairs, or excuse me, on the euro. You see again the first push up, second push up, third push up. On the way down, you see a first push down, a month's worth of sideways price action. Again, second push down, more sideways price action, third push down. What do you see on the way up? 3 clear cycles up. On the way down, this is why I've been saying for a while, it looks like we're going to get another push down because we've made a first push down, second push down, third push down. So for the last going on, a little over 3 years here, we've seen a uh, very clear cycle back and forth. And so that tends to be the way the market is driven. On an intraday basis, it will be a bit cloudier. And that's the thing is we get a strong indication of direction, but there's so many other things that we're looking for. We're looking for, what's the correlation? Are we seeing, where was the manipulation at? Are we seeing an area where we should see manipulation? Is there, like we just talked about, is there 200, 200 EMA? Is there a pivot at that point? Is there general support and resistance that smart money is going to manipulate in and around? And so these are other factors that go into that decision. And that's one thing that's important to understand with levels is they're not going to be perfect. And to believe what always and I don't everybody believes this when they come in the market because that's what everybody tries to teach you or tries to sell you, I guess is the better way to say it. It's easy to sell an XYZ weight to this market. And what I mean by that is if you tell somebody, okay, you do X, Y, and Z, and then you'll win 80% of the time, and that's the example. It's easy to sell that belief. But what always amazes me is that people, everybody buys into it multiple times, and they buy into that type of belief. But what's the end result? And that's something that I can't answer for you. You have to answer that end result for yourself on that type of a strategy that probably everybody's bought into because that's generally the way they're pitched. And so after a while, you got to say, hey, this what seems so simple as an XYZ way to trade the market, it just doesn't exist. And that's because the market is dynamic. It changes on a daily basis. Look at the volatility change we've seen over the last month on the euro. You've seen the euro go from low volatility to extremely low volatility. So the market is constantly changing. The way the market responds to news constantly changes. It's something that constantly changes, and that's why there will never be an XYZ way to trade the market. And that's what that's essentially what we get at in the forum is we understand the basic fundamentals of how they tend to drive the price, how they tend to manipulate the market, what we should be looking for. We understand those very basics, and then we move from that point forward. And this is, I think, one of the best, the simplest things somebody can use to really ingrain that in their brain is look at how the market tends to turn. If somebody were to just blindly trade stop run reversals, very simple strategy. I guarantee they'd be better off than any most other what I would term as a mainstream strategy out there. Even last Friday around actually this was Thursday and Friday. You look at what turned the market. We had traders in the room that were taking these. They're a little too, I personally didn't take it because it was just a stop run like that. Number one, I don't think I was around for this one. We had traders taking the stop run here, taking the stop run above this point. Again, because that tends to be the turning point in the market. That minute, it's something that a general support and resistance trader is going to say, man, that resistance was broken, and not really ever give any thought to not what the chart is showing, but what does the chart show about what smart money is doing? If they're searching out liquidity, if they want to sell the market, what's the best way to sell the market? The best way to sell them, the only way to sell the market is to induce buying. How do you induce buying? You drive the price above a high, sell into the buying pressure. Something very, very simple like that. And again, we go to the next day. What do we see? We see the market drive through a low before turning back up, turn through a high before driving back down. I'm. Are you speaking about this push down here? Well, one key here, and this is everything we do is in context. So if I talk about okay, we've seen a stop run here, a stop run down or up, there's usually context behind it that I haven't gone over. And on the euro, the way I had kind of discussed this was we had a first push, we came back, we had a second push, and when we saw this last manipulation below the lows, this was a possible third push. A lot of times, and not a lot of times, but I guess I'll say some of the times we'll see the third push being it'll be the completion of that move with a stop run, uh, with the stop run being the final third push. The only questions I had on the euro was the fact that each of these moves were not quite 90 pips. And we want to see a base. That's a baseline, and it's shrinking a bit nowadays because the volatility is down a bit. Uh, do you mean do I give buy and sell signals in the trading room? A stop run is a stop run regardless. If you're pushing beyond a major high or a major low, again, it's nice to think of the market in an XYZ way, and it's nice to say, okay, they accumulate during Asia, they manipulate outside of Asia in London, and that's nice to say, and generally that's the way it works. But again, the market's dynamic, the market changes, and to see a stop run is a stop run regardless of the time, and you'll see them during New York, the same as you'll see them outside of Asia during London. Let's see. Yeah. The downtrend is well established. An example, who buys? Well, you got to figure retail traders, as a general rule of thumb, are looking to are buying into, always trying to pick a bottom. So who's buying could be the answer could be, 1,000 different people. Can I tell you who's buying? I don't know. But it's also the fact that as the market goes down, you're running into more buying pressure as it gets into what people would term as a better and better price. Sorry, guys, I'm not repeating the question. I wanted to do that with the last email. Chad just reminded me. Sean, what do I use for the highly or the high and low? There's a pivot indicator. I believe it is. You know what I'll do? When I put the video up, I'll put a link to it. It's just a general pivot indicator. I think I found it on Forex Factory. It's nothing special. There's some general rules, and we've done a video on levels and how we look at levels. Yeah, I just need the name. Actually, if you can just write the name in there, if you type that name in the search in Forex Factory, you'll find it. Um, there's some general rules we'll look at for the cycles of the market, and number one is a time factor. The cycles tends to be over the course of a few days. On average, tends to be around 3 days, but can be shorter than that, can be a bit longer than that. And then again, there's no XYZ way to trade the market. So when you have these different cycles, you also have the depth of that cycle as well. Was that cycle, was that cycle 90 pips? Did it move? Did it move a baseline 90 pips? Did you see the market? Um, again, how long was that cycle? Also, the other factors of what was, if you're looking at the euro, what was the pound doing? That correlation factor. Those are some good pointers as to, was that truly a cycle or wasn't that truly a cycle? No, I'm not a member of, or I have not taken Steve's class. I get that question a lot, and I think I had actually a discussion with Kim this last a couple weeks back, and you guys are welcome to any members of Steve. She'll verify I wasn't and haven't, but from everything I've heard, Steve has a good class. He teaches a good class. I kind of get a lot of I have a lot of his I guess not really past members because if they're a member for life. But I think one of the biggest differences here, guys, is the fact that we gotta the one thing we teach as far as market manipulation is the fact that no matter which way you spin it, generally anybody who teaches market manipulation is probably going to come across the same way because there's only so many ways you can spin the fact of how smart money looks for the supply when they need the demand, and that at the end of the day, no matter what way you spin it, uh, no matter which way you spin it, that's really what it boils down to, and that's what manipulation searches out. Manipulation searches out how smart money was looking for the orders, and generally, how they do that is going to be the same way on a weekly basis. While it may visually look slightly different, there's only so many ways they can search out longs if they want to short the market, and vice versa. Terry, what I think of Martin's special indicator, I think that well, it's not a special indicator. It's a way he has charts set up, and he searches out. He looks for essentially the same thing. It's just in a different way. I will say Martin's a stand-up guy, and I think he offers a good product. He does a very good job of explaining things. He does things in a different way. He looks at volume, and judges accumulation a bit differently. He looks at tracking smart money activity in a different way. So I mean, I personally don't use it because I think there's an easier way to do it, but that's what he's comfortable with, and that's so that's doesn't mean I disagree with him by any means. I've noticed that they make higher 160 pip ranges and then direction begins to change. I'm not sure what you mean by that, Am. They do tend to cycle a high, um, and then take out that high again. The pivot indicator, guys, if you haven't seen that, John put it in there. It's VS underscore pivots. It's going to be an underscore between VS and pivots D, and then I believe it's VS underscore pivots D underscore V4. I believe is the full name. Really, Daniel, the 90 pip range tool is the reason he uses that, and the reason I use it is because that tends to be a baseline for how far they're going to move the market. As volatility changes, for example, nowadays we have a very tight volatile ranges that the volatility is very tight, meaning you're not seeing huge ranges. 4 years ago, 90 pips, you'd have missed out on bigger chunks of the move, and so you know 4 years ago, you'd been maybe we'd be, in another 2 or 3 years, maybe we're going to be saying, hey, we should be looking at the 150 pip tool, because as the volatility changes in this market, and anybody that was trading 4 or 5 years ago knows that, actually probably about 4 years ago, knows that the volatility was way up. We were seeing 300-400 pip days consistently in the pound, and so that tool is going to change with time as we see the volatility change. Right now, that tends to be a good area to look for. If you've caught One of the best things to understand is that if you've caught the manipulation of smart money, if you've truly caught when they're going to start a cycle, you're not going to see a 20 or 30 pip move. If it took them hours to accumulate that position, it's going to also take them a big move and a few hours to exit that position. And so that's why, if you've truly caught a cycle, you're going to at least see, generally at least see that large of a move. Roger, the lines on the chart, the red line is a 60 EMA and the blue line is a 200 EMA. Tony, as far as whether I classify the third push on the euro as the third move uh, because it was on news, that's something that it was either way, whether you're trading it based on the fact that it was or it wasn't, it still gave some decent follow through. It is a bit, always questionable, because when it does happen on news, there is a bit more question to that. That is, you're right on as far as questioning it because it was on news. Well, I trade New York only, and generally a lot of times we have to take what you typically see as a reversal during the New York session. It really depends on what we're seeing, though. If we've stayed in accumulation during London, well, then we may have an opportunity at a cycle of the trend. We also have a lot of opportunities at catching the end of a move. We go back on the euro, a couple good examples of that. Let's see here. This was the end of a third cycle down, and this happened to be during. Let's see here. Yeah, at the end of this move, the end of the New York session, we had a good opportunity at it. So the end of the third cycle down, and I don't have the levels marked out here anymore, but at the end of that third cycle down was giving us a good opportunity there. This was also another trade that we caught during the New York session. The end of the third cycle down here on the euro. This is back on March 6th. We had a first push down, we had a second push down, we had a third push down, and we were getting the first entry over here where I was taking it from. Also gave another entry with a stop run during the New York session here. So we get a lot of opportunities at those weekly reversals as well, which that can be really, if you need one trade in a week, that can be the one trade that really matters. Yeah, that's exactly it, Pat. It's often tends to be a time where they're accumulating a position, and that's why you see the market trade within a range during Asia. It sets up for the manipulation during London. How many traders trade the London breakout? How many traders are selling the break of the low and buying the break of the high? That's a very, very common strategy. So as they set a high as they set that range high and the range low during Asia, that sets the trap for manipulation during London. I just answered that question, David. I'm not sure if you heard me the first time around. Well, what is often seen as chop can be seen as a stop run or a bottoming or topping formation at the range high or the range low as well. New York is not, London is definitely the easiest session to trade without a doubt, and I completely agree with that. With that being said, I do very well just trading New York. So it's not necessary to trade the London session. Harold, which session is gets more opportunities? I would say the London session has better opportunities. Yes, it does. David, as far as the different cycles in the market, the biggest thing that I tell people is, and this is the deciding factor on whether people are profitable or not, is your subjectivity to the levels, and they give us a bias to direction. But at the end of the day, that bias means nothing if we don't get the confirmation of that cycle. Essentially, what I'm getting at is the basis for that is we have a good. There's a general way the cycles are going to be ran on a weekly basis. You start with the basic fact that you tend to be driven in three cycles. These cycles tend to come out of accumulation because without an accumulated position, what's the point in driving the market? It's not like you or I that simply clicks buy or sell and we're in the market with a full position. Their positions are accumulated over time. So we want to see these positions come off of a stop run or come out of an accumulation area. On the euro here, we actually had it come out of both. We can see the break above the high, multiple tests above that high, and right before the run, one last stop run, which somebody caught that trade in the forum. I'm not sure who it was, but I think I was looking at their chart way down here, and they still had a sell order on that. So whoever caught that and held it, uh, good job on that. Was it you, Brent? Yeah, that was a nice trade. Anyways, we'll show some examples of what we look for during the New York session. I'm trying to think of an example of recent trades here. The big thing during New York is that you're going to have a lot of opportunities at trading. You have to become accustomed to the fact that you're going to have more opportunities at trading ranges, trading stop runs on the range, trading bottoming or topping formations at range highs or range lows. That tends to be what we see. Now we go back to one example of a trade that we did take during the New York session. I'm not sure. Actually, this was outside of the New York session. Still generally within the New York session. I did not catch that from the lows, but again, we started with a very basic start. It looked like we were cycling down. Looked like we still had more to go, and so we had, depending on how these levels tend to pan out here, which uh, really one thing that people find is that once you've identified the direction of the cycle, that's giving you the indication of the probable direction. So it looked like we had, depending on how this works out, because the levels weren't, we didn't see a clear first push and a second push. I tend to believe that it's going to work out like this: first push, second push, and seeing a third push. But if that was the case, we'll go back to into the 15 minutes. So I had the belief that the cycles were to the downside. The euro, the correlation with the euro is confirming this. And again, we'll go back to, this was looking like the second push. So when I saw, it was a good example of this. We had a psychological barrier at 6,200. Okay, so we saw the market push back up to that psychological barrier of 6,200. What do we point out as far as, why do we look at pivots or moving averages or psychological barriers? Because retail traders tend to put their orders around this point. So as we see the market come back to this point, and on the first push through it, I'm not going to be doing anything. I believe the cycle's down, so I'm looking for a short. So I'd be looking for a stop run to the upside, or I'd be looking for a topping formation to the upside. And what do we see here? Well, we see the market come back to the psychological barrier and give a nice reversal legs or railroad tracks back to the downside, whatever you want to term that, as far as the candle formations go. So that's giving you at least some indication. And candles serve the very last purpose in triggering a trade. Some people use the confirmation entry I talk about at this point, um, and a couple other variations, but the candles serve the very last point. So when I saw that rejection, to me that was telling me there was a stop run through 6,200. The cycle is to the downside. I'm still expecting that third push down, and I see a push through that psychological barrier of 6,200. So that's giving me an indication that that's a possible or probable stop run. So I was waiting. The market came back up, pushed through it again, and was rejected again. And that's where I was taking the entry. I took it from 92. I ended up closing the trade for a couple pips of profit in the room. I think it was 3 or 4 pips in profit. I didn't want to hold it through the manipulation, and that ended up being a good thing because I would have been stopped out. The trade, even from what I would term is not not a spectacular entry, still gave up about 34, 35 pips. Not enough for me to take a profit on it, but was a good example nonetheless of how they tend to manipulate the market through a psychological barrier. We go into New York, even on news. This was another thing that I wanted to point out. I've put out a couple videos on the manipulation we tend to see around news. So what did we see? Again, what did we see here before the market turned back to the upside? And this is probably something where people will overcomplicate it, and that's what's going to make the overcomplication of something is the biggest downfall of traders. Trade it at face value, guys. It doesn't. You don't have to overcomplicate the fact that when they want to go long, or whether you're going to see a short-term push long, you're more than likely going to see them drive it through the lows first. See them drive it through the nearest lows. If they want to drive the market down, they're going to drive it back past the previous high. That tends to be what happens. Is it gonna? Are you going to see a trading opportunity every single time for every move? No, you're not. Do you need to catch every single move? No, and you never will. I don't use any personal time area for getting out of a trade. The only time I'll use time in essence is if I'm getting into the very end of the New York session and the trade hasn't moved off. I tend to get a bit more leery and trade or close trades at that point in time. If I'm going to take a partial profit, I'm going to be at least 2 to 1. And this is probably the most important thing I can tell you guys. I've been in this market for a long time, seen a lot of traders come and go, and I can tell you that the amount of traders I know that I met that I knew were profitable, I can count them on one hand. But one thing I'll tell you is traders that I've met along the way, and I'm not talking traders that have become profitable. I'm talking traders that I initially met that I knew were profitable. What did they use uh, as their form of trading, or what made them profitable as a trader? And I can tell you right now, it's never their win loss ratio that makes a trader profitable. It is they may have a good win loss ratio, and that may be part of what makes their profitability. But I can tell you right now that the common denominator I have always seen between every single profitable trader is the risk reward. And that's because somebody with a 2 to 1 risk reward can win 50% of the time and make a darn good living in this market. And that's why I literally don't know a single profitable scalper. And I could probably say to this room, there's nobody in this room that will show me a track record or trade live in front of a room that is a scalper. And I feel comfortable saying that in front of 100 traders because I've I've never been proven wrong. I would love to be, uh, you know, I'd be happy to have a scalper come in and trade in front of the room because I think people would like that. But the bottom line is nobody's profitable from scalping because it's extremely difficult to run a good risk reward. And again, I always say that I live for the day that somebody says, Sterling, you're an idiot. Uh, Here's my strategy that's based on indicators. It's an XYZ way to trade the market, And Sterling Dimension, you're an idiot. Here's the way I do it. I can't wait for that day. I'm going to be overjoyed that day because that's going to take a lot of the stress and decision making out of trading. Because no matter how long you've been trading, there's always subjectivity, stress, and everything else that a normal trader will experience. So the more you can take away from that, for example, with an XYZ strategy based indicator or strategy based indicator based strategy, that would be great. But it just it never seems to work out that way. And the key there is the fact that it goes right back to scalping. There's and what we're talking about with risk reward. You don't you just don't find profitable traders that don't maintain a good risk reward. I've personally never met one. I'm sure there's some out there, um, but it's very, very. I personally don't know one of them. Pat, I would disagree with that. When we see a stop run, generally we're gonna be able. Pat is just for anybody that's on listening to the video, saying there's 2-to-1 setup is rare, and I personally would disagree because when we see a stop run, generally we have a 20 pip stop. We're allowed, or we're generally able to get in with a 20 pip stop, and almost always these stop runs are giving 40 pips at the least. And you're not going to see 10 of them a day with that, and I think maybe that's um, one of the things what you're trying to get across. But any profitable trader will tell you that it's always the quality of the setups. It's not the quantity of the setups. And so generally we see a few good setups on a given day. And one of the best things I told traders this week, I think one of the most beneficial things I mentioned was if you struggle with your patience, with your discipline, with your subjectivity of taking a trade, give yourself a 2 trade limit. Only take 2 trades that week and say, okay, you know what, I'm sticking to 2 trades, so I better be very, very selective because once I make those 2 trades, I can't make any more. And that starts getting people focused on, okay, where's the best stop run? What cycle are we in? Are we seeing a clear cycle? If we are, well, you know what? I'm going to wait for super clear, a very clear manipulation outside of the Asian high or the Asian low, depending on the cycle direction. Are we seeing a clear stop run? Have we seen 3 cycles complete themselves? Has it been over the course of 3 days? If we have, can we catch the midweek reversal? And these are all things that what's I think it's the simplest things that people discount because a midweek reversal is something that has been around for longer than I've been alive. The market tends to, it's not anything, uh, anything that's new. A midweek reversal is something that's been taught for forever because that's the way the market tends to work. Yeah, and a demo, like you said, a demo is great, but you got to look at it like what you're